Hi everyone. In today's lecture, we're going to take a deeper dive into the concept of time and explore how it unfolds in a fractal rhythm. I'll show you how this applies to the markets and why understanding time this way can change the way you see price action.
Before we begin looking at time itself, we first need to establish a bias. Are we bullish, anticipating higher prices, or are we bearish, looking for short opportunities? This step is always carried out on the higher time frame. Now you'll notice that the slides I'm showing don't include a specific time frame. That's intentional. I want you to understand that this is where you define the kind of trader you want to be. For example, an intraday trader might use the hourly chart as their higher time frame. A scalper could use the 15-minute chart. A swing trader might be working off the weekly or even the monthly. I'm not here to tell you which time frame to use. Instead, I want to show you how markets are fractal, meaning the same structures and behaviors repeat across all time frames. Whether you're looking at a 1-minute chart or a monthly one, the underlying patterns and principles remain the same. Right now, we're in a buy program, expecting higher prices. Price has been breaking through imbalances on the left side of the curve and used the blue highlighted range as support before pushing higher. It might not look like a huge move here, but I want to zoom in on the low that formed at the blue highlighted range. This is something we could have anticipated. I'm going to show you how we could have built a trade idea off that move using time cycles, specifically focusing on AMD. Zooming in, we can see that as price moved down into the blue highlighted range, it stopped just short of tapping into it. Then we got a retracement. This move engineered sell side liquidity and also left behind an imbalance above. Now remember, price is always seeking two things, liquidity and imbalances. In order to deliver efficiently, it must trade back into imbalances at some point in time. In this case, we took out that sell side liquidity and repriced right into the blue highlighted range. That becomes our POI, our point of interest. And don't forget, from the higher time frame, we're bullish. So we're expecting a low to form somewhere in this area. Now ask yourself, if we break above, where does price want to go next? It makes sense that the algorithm would target the imbalance that was just created. So how do we use that information to frame a trade? This is where things get interesting. Let's zoom in even further and break down this price action. By zooming in, I can now see the relative time cycle highs and lows. Don't worry, I'll share the exact time frame at the end of the lecture. For now, just remember, this is fractal. The specific cycle or time frame I use doesn't really matter. What matters is the logic you build around it. Looking at this chart, you can see that accumulation stopped just before reaching the blue highlighted range. From here, we can apply the purge and revert model, where price takes out the PXL into a key level, then reverts back toward the PXH. And what's sitting above that PXH? An imbalance, which is exactly what we anticipate price to target next. But we don't just stop here. Remember, Zusi has mentioned this before. Each cycle has its own AMD. So let's zoom in even further and get ready for this, because I believe this will be a real light bulb moment for a lot of you. Each cycle tells a story, and the next cycle always refers back to the previous one. Price can only do two things, purge and revert, moving from PXL to PXH if we're bullish, or PXH to PXL if we're bearish. Or if we break above the previous cycle high when bullish, price will use that level as support. Conversely, if you're bearish and price breaks below the previous cycle low, it will act as resistance. Now, with the logic framed from the higher time frame, take a look at this chart. Can you see the opportunities that studying the price action reveals?
Let's zoom in one last time. Can you see how, when you frame a trade idea from the higher time frame, you can fractalize down to specific areas where you expect price to form a smart money reversal and start to monitor order flow? What's really interesting is that when your anticipation starts to play out in these lower fractals, the results will show up on the higher time frames. So to sum up, understanding time as fractal allows us to connect the dots between different time frames. By framing our bias on the higher time frame and drilling down to the lower fractals, we can anticipate smart money moves and better monitor order flow. Remember, The patterns you see on the smaller cycles aren't isolated, they feed into the bigger picture. When your trade ideas play out on the lower timeframes, you'll start seeing confirmation on the higher ones, giving you more confidence and clarity in your trading decisions. Keep practicing this fractal approach, and over time, it will transform the way you read the markets.
And here are the charts, complete with the time frame intervals. While some might call anything below 1 minute noise, we refer to it as precision because that's where the fine details come to light. Remember, the main goal here was to highlight the fractal rhythm of time inside the markets. These specific timeframes aren't really important. I included them to show you the level of precision the algorithm works at. I hope you found this lecture insightful. Thank you for taking the time to watch.